There's so much more to investing than just Canada and the US. And in this video, I'll go over my top picks for the best emerging market ETFs in Canada. Hey, what's going on? It's Chris here from Wealth Awesome, and I'm back in Canada. Diversification is an important tactic against market fluctuations and portfolio crashes. But you don't need to limit yourself to the typical sector diversification, that is, investing in different industries and asset class. Geographical diversification can be a very powerful way to diversify as well. And it can grant you access to a new array of growth opportunities that you just can't find locally. I've always found emerging markets much more exciting than the standard mature market that Canadian investors are used to. They also help rid your portfolio of the home bias, that is, locally concentrated investments. And instead, you can add some international exposure to your investments. This video will help you go over some of the top emerging market ETFs in Canada. Number one is the iShares Core MSCI Emerging Markets IMI Index ETF, and it trades under ticker XEC. The first emerging market ETF is from BlackRock. The ETF is made up of equities and not bonds, unlike many emerging market ETFs, and has 2,477 underlying holdings. The core holding inside the ETF is a portion of a US ETF with net assets of US $55 billion under management. The four largest equities in the ETF are Alibaba, Tencent, which is a Chinese holding company, Taiwan Semiconductor Manufacturing Company, which is one of the world's most valuable semiconductor companies, and Samsung Electronics. And these four companies make up about 21% of the total weight of the ETF. Geographical distribution of the ETF leans heavily towards China and Taiwan, and that makes up about 52% of the fund. And it's a theme that you'll find very repetitive among the next emerging market ETFs in this list. And South Korea and India are the third and fourth most prominent regions. Sector distribution of the holdings are a bit more even, with consumer discretionary, IT, financials, and communications taking the lead. The reason why this ETF tops our list is that it provides decent capital growth potential at a decent MER. But one negative aspect of this ETF, though, is that its distributions are bi-yearly only. Second pick is FTSE Emerging Markets All Cap Index ETF, and this trades under VEE. The second ETF is from the second largest investment management company in the world, Vanguard. Regionally, four countries make up 75% of the share of this ETF, which is China at number one, Taiwan, then India, and Brazil. The sector exposure is slightly different, with financials in the lead, technology and consumer services in second and third. The three most extensive holdings are the same: Alibaba, Tencent, and Taiwan Semiconductors. And the total number of holdings are over 5,000. The fund also has the potential for capital growth, and the fund showed remarkable recovery after the pandemic-driven crash in the regional markets. This shows the resilience of the emerging markets that make up this fund. This fund pays quarterly dividends. The fee and MER are low enough that they won't shift your bottom line too much unless you are investing a large portion into this ETF. Third up on the list is the RBC Quant Emerging Markets Dividend Leaders ETF. This little ETF with not so little a fee is from the Royal Bank of Canada, or RBC. The ETF pays monthly dividends and offers the best yield on this list. It's the 5-year growth rate, though, not as fancy as the previous two, is still far better than negative. And this fund is also focused on China, Taiwan, South Korea, and India. Together, the four emerging markets make up 71% weight of the total fund. It's the first fund with a very manageable number of holdings at only 177. And it's probably because this ETF is created with dividends in mind, and most of the underlying holdings might pay regular dividends. It might also be the reason why the fees are so high. Synchronizing different dividends, some of them monthly, some quarterly, and some may be on a different frequency, to pay a neat monthly dividend must require some serious active planning. Its top holdings don't include Alibaba, but Tencent, Samsung, and Taiwan Semiconductors are there and make up about 19% of the fund's weight. It's rated medium to high risk, and that's 4 on a scale of 5, with 5 being the riskiest. Number 4 is BMO MSCI Emerging Markets Index ETF. This trades under the ticker ZEM. This sizable ETF is from BMO, or Bank of Montreal. It's the fastest growing ETF on this list and probably the oldest, with an annual growth rate of over 8% based on the past 5 years growth. But there is a catch. It distributes its earnings annually, which might make it less attractive to dividend investors. It tracks the progress of 26 emerging markets, but the bulk of the weight is made up of China, Taiwan, South Korea, and India as usual. Its holdings are a bit different in the sense that the bulkiest holdings inside the fund is another ETF, the iShares MSCI Emerging Markets ETF from BlackRock, which makes up about 11% of the fund. The rest of the top 5 are exactly the same as the first ETF on this list, the iShares one, and together the 5 holdings make up 1/3 of the fund. And the total number of holdings is 866 different companies. Number 5 is McKenzie Maximum Diversification Emerging Markets Index ETF. This trades under the ticker MEE. The last fund on this list has thankfully mixed things up a bit. In this fund, the regional distribution is a bit different. And after China, which makes up 25.4% weight of the fund, there's India with 19.6% and then Taiwan at 13.5%. The sector distribution is also a bit different, and healthcare leads with IT as the second most prominent sector. It's also the youngest ETF here and was created just 3 years ago. The top 5 holdings in the fund are NIO Inc. from China, which is a smart car manufacturer, Taiwan Semiconductor, Goldfields Limited from South Africa, which is one of the world's largest gold mining firms, and Anglo Gold Ashanti, which is also from South Africa, and it's also another gold mining company. There's also Li Ning, which is a sports store and goods company. This fund is a bit different, and as it's just 3 years old, it's yet to be seen how it will progress. Its creator, McKenzie Investments, might not be as well known as BlackRock, but it's a sizable enough investment firm that's been around for over 50 years and has over $140 billion worth of assets under management. So how to buy emerging market ETFs in Canada? There's many ways to buy emerging market ETFs, but the cheapest way by far is by using a discount broker. I used to use the discount broker Questrade for all of my stock and ETF trading, but I've recently started using Wealthsimple Trade as well because it offers free buy and sells for ETFs, and there's a $50 sign up bonus in the description below. All right, so what do I think about emerging market ETFs? Adding one of these emerging market ETFs in your portfolio won't just give you geographic diversification, but might also introduce some additional growth to your portfolio. Many emerging markets, especially China, showed rapid economic recovery after the pandemic. And once the US and China trade war settled, China heavy ETFs could perform better than many of the local indices. I would only though invest a very small portion of my money into emerging markets though, as it is a lot riskier than investing in developed markets. Somewhere about 3 to 10% of your total portfolio might be a good place to start. All right, so since you made it this far, make sure you like and subscribe to the channel so you don't miss out on future tips. And also be sure to check out the blog, wealthawesome.com. It's one of Canada's leading personal finance blogs, and I've been really excited to work on it. It goes into this topic in way more detail and also has many other topics for Canadians to look at. And as always, thanks for listening.